Investing in the stock market exposes investors to the possibility of market collapses. Because of the unpredictability inherent in the stock market, I wouldn't be able to tell you an estimate of when the next crash will occur. If we could accurately forecast the next market downturn, we could take precautions to avoid it. At some time in the future, an unexpected incident will cause a significant drop in market value, and you'd better be ready for it when it does happen. No matter how unlikely, every investment is exposed to the possibility of a significant economic collapse. This has occurred in the past, and it may happen again. If it does occur, years of laborious savings and retirement assets may be wiped away in a matter of hours. What's up, folks? Welcome to Capital Finance. Great to have you back. In this video, let's take a look at how you can prepare your investments just in case a stock market collapse happens, because we all know it will happen sometime soon. You are in luck because there are actions that you may take to protect the majority of your assets in the event of a stock market crash or even a worldwide economic catastrophe. An effective defensive plan's two most essential components are preparation and diversification. The two of them working together can assist you in weathering a financial storm. But wait, before we go on, make sure you've hit the like button and let's begin. Number 1. Diversify your investment portfolio. If you want to protect your savings against the devastating effects of a prolonged bear market, the single most critical step you can take is to diversify the holdings in your investment portfolio, depending on your age and the level of risk you are willing to take. It is possible that it might be fair for you to invest the majority of your savings for retirement in either individual stocks, stock mutual funds, or exchange-traded funds or ETFs. However, you should be ready to transfer at least a significant amount of your money into something more secure if you sense that a catastrophe is on the horizon. People may put their money into a wide variety of investments these days, each of which has its own amount of risk. Some examples of these investments include stocks, bonds, cash, real estate, derivatives, cash value life insurance, annuities, precious metals, and other investment vehicles. You may even try your hand at other assets, such as purchasing a modest stake in an oil and gas production that is already producing revenue. If you want to make sure that you still have something once the economy hits rock bottom, the easiest way to do is to disperse your money among a number of these different categories. Number 2. Run for safety. When there is significant turmoil in the markets, the vast majority of experienced traders switch their holdings to cash or cash equivalents. You should probably perform the same thing if you have the ability to do so before the crash occurs. If you can get out of the situation fast, you will have the opportunity to get back in when the costs are considerably lower. Then, when the trend inevitably changes, you will be in a better position to profit from the appreciation of the asset. Number 3. Consider getting a guarantee. It is pretty unlikely that you would choose to place all of your funds in guaranteed investments. They just do not provide an adequate return on investment. However, it is prudent to maintain at least a modest amount of your wealth in something that will not decline in value along with the markets. A safe choice will be bank certificates of deposit or CDs, or treasury securities if you are an investor with a short-term horizon. Treasury bonds may not be the best option for long-term investors, since other investment vehicles such as fixed or indexed annuities or even indexed universal life insurance policies may offer higher rates of return. It is possible to earn a competitive income from corporate bonds and even the preferred stocks of blue-chip businesses. The risk level associated with these investments ranges from low to moderate. Number 4. Hedge your bets. If you anticipate a significant decline in the near future, don't be afraid to position yourself so that you may profit straight from it. There are a few approaches you can take to do this, and the one that is most suitable for you will be determined by the level of risk you are willing to take and the amount of time you are ready to invest. If you possess shares of a stock that you believe is going to go down in price, one option that you have is to sell those shares and then purchase them back when the chart patterns indicate that the stock is probably close to reaching its bottom. When you already own the stock you are trying to short, this process is much simpler. If the market goes against you in this way, all you will need is to hand over your shares to the broker and pay the difference in price in cash. You also have the option of purchasing put options on any equities that you currently hold that can do so and on any one or more of the financial indexes. If the price of the underlying securities or benchmark falls in value, the value of these derivatives will skyrocket in response to the increased demand. Number 5. Find the silver tax lining. Even if you cannot protect your assets directly from a collapse, there are still methods for you to mitigate the negative effects of the losses you have sustained. One strategy that can be utilized for losses that occur in taxable accounts is known as tax loss harvesting. You close out all of your loss positions, wait at least 31 trading days, and re-enter the market. This implies selling before the end of the current tax year to realize the loss before the first of the year and then repurchase the stocks, if you so desire, in 31 days or later. The Internal Revenue Service or IRS would classify the repurchase of the stocks before this period as a wash sale, which would prevent the taxpayer from being eligible to claim a loss. After that, you may deduct all of your losses from any gains you have accrued in those accounts and come out ahead overall. You have the ability to write off up to $3,000 in annual losses against your regular income, and you can also carry over any excess losses to a subsequent year. Number 6. Pay off your debts. If you have significant obligations and you notice signs that severe weather is on the way in the markets, it may be in your best interest to liquidate part or all of your assets and use the money toward paying off the debts. This is a brilliant move if you carry a significant amount of high-interest debt, such as a balance on a credit card or other consumer loans. While the bear market is raging, at least you'll be able to keep your balance sheet in a pretty solid position. Paying off your home mortgage entirely or at least a significant portion of it might be another intelligent financial move. It's always a good idea to reduce the number of monthly commitments you have. Lastly, number 7. Consider switching to a Roth account. Consider converting part or all of your conventional individual retirement accounts or IRAs or other qualifying retirement plans from previous employment, such as pensions or profit-sharing plans, into Roth individual retirement accounts. At the same time, the valuations of these accounts remain low. This will have the effect of lowering the total conversion amount and as a result, the amount of taxable income that you are required to report. For instance, if the value of your IRA drops by 30%, it implies that the amount of money for which you may avoid paying taxes when you convert the entire balance in a single year is reduced by 27%. Even after the conversion, you can fall into a lower tax band than the one you were previously in if you were jobless for all or part of the year. This is because you will likely be in a lower tax bracket overall. Unfortunately, economic turbulence and slumps are both natural and necessary components of a functioning market. Crashes give rise to new chances. They rid our system of obsolete industries and business methods, which in the long run help to enhance our quality of life. This is a vital component of capitalism, and looking back on it, we can see how moments of stress contribute to the system's overall health. If you are adequately prepared for a downturn and have developed positive habits, you will find that a downturn is one of the most significant investing seasons. Downturns can be beneficial to someone's portfolio by providing them with the boost that many other investors fail to take advantage of. Investors can make significantly higher returns than average while the market is falling. And that's it for this video. I hope you had some takeaways. And before you go, make sure to like and subscribe for more videos like this. See you next time.